Hey you guys, my name's Jeff. Welcome to the channel. If you've been here before, fantastic. Take a seat and stay a while. And if you haven't, grab a seat and stay a while, because today I'm going to show you a video clip of one of the most brilliant investors of all time teaching you a super valuable lesson. I cannot give you investing superpowers. You are living through a bear market. And for a lot of you guys who have not been investing for more than 5 or 10 years, this is really the first time that you've had a stock market that has just gone down, just grinding month after month. Stock prices going down week after week, possible stock market crash, interest rates going up, and inflation. And you know, there's a lot of noise out there. But it's not the first time. In fact, these things happen, you know, maybe every 10, every 15 years, stock market crashes and the economy, bad things happen, but you're gonna make it through, okay? And this video I'm gonna show you right now is going to prove that times of massive speculation like we've had in the past couple of years have happened. Immunize yourself. Get yourself so that you are immune from the pressures of feeling like you have to jump in and out of the stock market or choose some new hot stock just so you can, 10x your money, because these are impractical, pie in the sky ideas. It's not reality. I am going to help you focus on this goal of dealing with reality and doing so in a way that makes a lot of sense. So as promised, let's take a look at this video.
We sat in on part of a seminar at the Graduate School of Business at Columbia University. After all, it's older than the stock exchange. And we thought professors familiar with the language of the street might treat the market with detachment. Dean Courtney Brown and Professor Benjamin Graham were instructing future brokers and customers men.
The explanation cannot be found in any mathematics, but it has to be found in investor psychology. You can have an extraordinary difference in the price level merely because not only speculators but investors themselves are looking at the situation through rose-colored glasses rather than dark blue glasses. It may well be true that the underlying psychology of the American people has not changed so much, and that what the American people have been waiting for many years has been an excuse for going back to the speculative attitudes which used to characterize them from time to time. If history counts for anything, that the stock market is much more likely than not to advance to a point where of real danger.
So who would have thought it, right? Benjamin Graham, the intelligent investor. I think that is the only clip of him on the internet, on YouTube. And I love that you get to see him talking about stocks and the reasons that stock prices go so high that the prices are totally detached from the actual value of the business. And that's what happened. That's what happened in 2020, 2021, when people had all this extra money and just pouring it into the stock market, buying stocks on Robinhood or on whatever. Did you ever think you would see Benjamin Graham himself, the author of The Intelligent Investor, and also Warren Buffett's mentor and teacher at Columbia? He's telling you that this thing that we're observing right now, this massive speculation and investor psychology, which sees everything through rose-colored glasses, is excited just to gamble on stocks, just to put money into the market because they see the prices of their stocks going up and up and up. But in reality, they have been looking at stocks through rose-colored glasses, and that makes everything look beautiful and rosy and happy, and they can see no end in sight. But in reality, they need to look at investing through blue-colored glasses. Investors need to realize that you got to deal with reality that every stock is just a part of a business, and if that business is not profitable, then how can you be profitable long-term as somebody who is a part owner in that business? It's really simple. It's real basic. Interesting thing about Ben Graham is he was profoundly affected by the stock market crash. He lost a lot of his money in the stock market crash in 1929 and in the Great Depression after. And so he was really put a lot of his energy and thought into protecting money and not losing it as an investor. And so he was much more conservative even than, say, Warren Buffett is now. Buffett is a very careful or conservative investor. He doesn't take unnecessary risks, but I would say that he is not driven by the same kind of fears that Benjamin Graham had because of Graham's real experience in kind of living through that 1929 crash and losing so much money. Nobody knows if this is going to end in the next 6 months, in a year, in 2 years, in 3 years. But you just need to live your life in such a way that your expenses are low and, you know, try to keep some money in a savings account. Keep some money so that you can be prepared and you're not dependent on other people to bail you out of tough situations. And, you know, what I do, I can only speak for myself, but every month I make an investment into a total stock market index ETF. And I like VTI, Vanguard Total Stock Market ETF. But there are a lot of great ones out there. VOO, which is the S&P 500 ETF, and VB are all great ETFs. They're just very well diversified. And, you know, I invest in stocks as well because I love stocks, and, you know, we're seeing things happen in the market that I just haven't seen in the last decade. I've just started investing in Google, and the price to me under $100 a share just seems kind of unrealistic and unfathomable to me based on how strong their business is, how much cash they have on their balance sheet, and that they own YouTube. The mistake that I made back in 2008 was when the market declined, and it did it pretty steeply. Sometimes it would lose like 10% in a day, and it would do this, you know, for a couple days, and then it might bounce up a little. And then I just went all in into one stock that I really liked and I thought would be a great investment for the long term. And I was wrong on that particular stock. It wasn't a horrible investment. It went kind of sideways for many years. But I was really hoping, because I bought it so cheaply, that it would eventually like bounce back up and recover in a really powerful way. But it didn't. And if I could go back in time, I would have either invested in a diversified ETF during that stock market decline, or I would have invested in a few stocks, because sometimes you may want a certain stock to go way up, but that doesn't mean it's going to happen. The stock doesn't know that you own it. There's a lot of hype about picking the perfect ETF, but as long, I believe, as it's diversified, so you're not going all in on one stock or going all in on one sector like the ARK investment funds tend to do, I think that you'll be okay over the long run. And I think all three of those ETFs, VTI, VOO, and VB, are all very well diversified across their asset classes. It is great to see you guys again. Whether you're seeing the world through rose-colored glasses or blue-colored glasses, I hope things are going really well for you guys, and I look forward to seeing you in the next video.